Everybody has a plan until they get punched in the face. Do you relate to that at all? Did you have a plan back when you got into the stock market and you bought Tesla early? Or maybe you bought cryptocurrency early and things were going well and you had a good plan. And then you got hit in the face. And then you got hit again and again and again. And that's what's happening. And many of you have never experienced this before. You haven't really been hit in the face. Oh, you went through the March 2020 Corona crisis scare, but that came back, and it was easy to see that it was going to come back. And the referee stepped in and threw some funny money at you, and you got more to invest, and you wrote it up. And then come this past November, you got hit in the face. And now you're saying, and that's why you're at this video, you saw my thumbnail, stock market prediction for the next 6 months, and you said, maybe he can give me a new plan. Well, maybe I can, maybe I can't. But what I want to do is share my plan with you and share my experience with you. I've experienced this before. I've lived it in the dot-com bubble. I've lived it through the subprime crisis, and so I know what ultimately is going to happen, and I have a good idea as to what circumstances are going to change the direction it's in now and how long it's going to last. And that's what this video is about. It's about admitting, first of all, you've been punched in the face and you're hurting from it and you don't know exactly what to do. Well, the first thing I'll tell you to do is to look at history, and then I'll tell you the reason it hurts so much when you get hit in the face is you're trying to do it by yourself. When you get hit in the face and you don't have a team, you don't have a posse, you don't have a group that can rally around you and help you up and encourage you and feed you information, you're going to quit. You're going to quit. 98% of the people who get punched in the face quit. This video is about your future. It's not financial advice. It's financial education. And at the end of the video, I'm going to tell you exactly what to do and how to get up off the mat and put your face back on and go back at the fight. Let's get this out of the way. And oh yeah, remember to subscribe to the channel because I got more of this coming.
Best of Us Investors presents Carrie Griegmeyer.
There's an old saying, it says that the one thing we've learned from history is that we don't learn from history. We don't go back and look and say, what happened back in the dot-com bubble? What happened in the subprime crisis that I can learn from? How can I see a pattern here? Can I see some things that happened there? Can I study the dot-com bubble or the subprime crisis and learn more about it? Can I read the books? Can I watch the movies and then say, oh, that's why that happened, and that's probably what's going to happen here. So what I want to do, first of all, is take you to one of my primary tools. And I believe that if you're going to pursue anything and you want to do it successfully, you got to have the right tools. And those tools, if you don't have the tools, you're working with your hands the whole time. You don't have hammers, you don't have saws, you don't have Caterpillar's biggest dirt mover. If you don't have the tools and all you have are your hands, you won't succeed. So one of the tools that I use is Trading Views. It gives me the ability to see patterns and to see what is going to happen in the future based upon what's happened in the past. Let me take you to my computer and share this with you. Okay, if I'm going to understand what's going to happen in the future, I got to understand what happened in the past. And so what I'm showing you here is one of my tools that I use to help me navigate myself through the stock market, and this is Trading Views. And it's a chart I built on the QQQs, and I do that because I use the QQQs because I believe in innovation, disruption, and change drives the stock market. And if I can anticipate it, I can make some money in it. So what I first want to look at is we're in a bear market. Where are the bear markets that I'm familiar with and most familiar with and have experienced? Well, the dot-com bubble, the subprime crisis, and now this reset or recession that we're dealing with. And if I look at the dot-com bubble, I can see that it lasted roughly 18 months from its high to its low, and it went down about 83%. And if I put a Fibonacci on it, I can see it far surpassed the 50% pullback as well as the 76. So it went all the way for 83%. If I come to the subprime crisis, I have a similar situation. This one lasted 16 months, and as you can see, it dropped about 53%, and then turned and came up. The other thing I want to point out to you on this, because liquidity is important. As long as there is money to invest, that it will be invested. And this dark green line is our national debt. Back here in 00, it was $4 trillion. There, I show it there. In 08, it had doubled. It had gone up to $8 trillion. And then as we got to the pandemic, we basically added $1 trillion to our debt every year along there. So when we got from $8 trillion in 2008, in 2020, it was up to $20 trillion. Now I want you to see this green line. This is a $9 trillion increase in our national debt through the relief programs that we created. So it went from 20 trillion to 29. And notice how it went right, the stock market went right up with it. Well, that makes total sense, because if you're flooding the market with increasing your cash supply by 40%, that money has to end up somewhere. Yeah, it ended up on grocery bills and paying rent and keeping the economy, people liquid. But eventually it ends up in somebody's pocket who doesn't need it for food and shelter and well-being. And so it ends up in investments. It ends up in the stock market. And that's what created this. Now, that fast flow of money, what I call funny money, stopped in 2021, but the ramifications and the effects of it continued for roughly another year. And that took us to our top in November of 2020. And that's when the pandemic was pretty much in our minds, behind us. We went back to work. We started our new lives, and and we started spending our extra money on our new lives, on transportation, on food. We were getting out of our house, clothes, whatever. And so the investment, the inflow of capital into the stock market slowed down. And then we got into the Biden administration. There was not the flow of money. There was a war that started in, I believe it was in March of right about here. And we saw interest rates. Powell said, and everybody said, the economy was overheated. And it was overheated because of the $9 trillion that was thrown into it. And so they needed to raise interest rates to slow the economy down. And then right along that came the Ukraine-Russian war, which increased gas prices. And we had a perfect storm for a crash. And that's where it's at. And as long as we understand that, we say, okay, but what happens next? Well, I think it's something that I believe in is you drew a lot of amateur investors in here, and they created this surge in stock prices. I mean, the EV market went crazy. SPACs went crazy. GameStop and AMC theaters, and it just crazy things happened in the stock market. Well, when crazy things happen and crazy people get involved in the stock market, it's got to be flushed out. And so I've coined a term, and I've heard Jim Cramer take it from me, the flush. The flush is when all the amateurs say, I'm getting out of here. This doesn't make sense anymore. I can't keep of it. And you literally flush them out of the stock market and see what as it happened, and you hit a peak. And that peak lines up with when the market hits its bottom. Very, very evident in the subprime crisis. Look at the increase in trading, and most of that is selling, and then everybody just says, I'm out of here, and the toilet flushes, and the market gets back on its normal path and actually sees a decrease in value. Well, we can now see, if we go back to the coronavirus, we can see that growth in volume, but we have yet to see the flush. We have yet to see where everybody's margin calls are called. Everybody is saying, I'm going back to playing in real estate. I'm going to concentrate on my job. I don't have time for this nonsense anymore. I've lost everything. I'm bailing out. I'm going to live on my 401k where it's at now, and I'm getting out of that nonsense mutual funds and ETFs, and I'm going to cash. Okay, or I'm going to do that crazy bond thing they have that I can now make 9%, but I can only put so much in, and I can't have. That's what the flush is going to look like. And I believe that's going to come somewhere. I know it's going to come after July, because July, and I want to take you to my Seeking Alpha and show you earnings projections, particularly on the FANG stocks. They're going to have some disappointing earnings. They're not going to meet the numbers of prior year, and you're going to see that part of the market drop. That's my belief. And then you've got the interim elections. And I believe there is going to be a swing towards the Republican Party, and there could be a change in the power in the House and the Senate, and that's going to have an effect. And that's going to create either more fear or more optimism. I believe if the Republicans take over, it's going to create optimism. And that's where I want to look at the earnings in July. I want to watch the volume, and could I get my flush? And then if we get to November and the Republicans kind of set up that we're taking control, we could see the turn then. That's what I'm watching. Now, again, I really don't care, because history also tells me, as I can see here, that with time and with change, innovation, and disruption, this thing's going to turn around. And it's going to turn around somewhere, I believe, after November. I won't get any more specific on that, but what I want you to watch is what's happening in Russia. Is that backing down, or is it picking up? At the same, what's happening in China. I believe China is going to collapse. I really do. We've forgotten about the real estate crisis they have. That has not been fixed. We've ignored their one baby policy and their inverted demographic pyramid. That can't be fixed because it takes 20 years to make a 20-year-old. So that is a problem in China as well. Then inflation. If the Russian war stops and the gasoline prices just level off, we'll be okay. Okay? And then interest rates, they're going to continue to go up, but we'll get used to that. I mean, I'm of the generation where 8% was normal. And I think we'll learn that 8% is normal, which will slow down the real estate market. So we'll see this little bit of a recession. And then what you need to be watching is healthcare. Are the genome sequencing and the genome editing medicines, cures starting to take function? Are we making moves to correct our supply chain? Are we going to pump more oil and forget about global warming and the future of energy? Someone else will make that decision. It won't be me. And then the big change is the Revolution 3.0, and that's driven by data. And as I have said, that's my data. You're going to need to pay me for that data. If you see things like this, if you see Google starting to say, hey, that program we have over at YouTube really works because it engages our contributors, maybe we should think about paying people for their search activity. When you see that, you know that AI is stepping in because it's going to take artificial intelligence. It's going to take software to make that happen, but it will happen. I'll guarantee you, I hope it's in my lifetime, but it will happen. The digital revolution made billionaires out of a few people because they monetized our data. Okay? It's just like they came into our backyard and mined our gold and said, thank you very much. We'll move on now. No, that's going to change. It's going to take a political move, and you can do that by sending these videos to your congressman. We must get paid for our data. This will take care of a lot of problems. It will create a universal wage. If you can get a monthly check from Google, Amazon, Microsoft, Apple, and Facebook, okay, and it doesn't have to come through the government, all right, that's what's going to happen. Now, again, prediction for the next 6 months, I think this will turn sometime after the midterm elections, and then we'll be off to the races. Or it will trade sideways until March of 2023. I think we have two events coming up in the next 90 days that you gotta focus on, and you gotta recognize they're going to have an influence and could totally change what you might think is going to happen. And the first one of those is earnings season. The reason some of our FANG stocks have dropped substantially was their first quarter earnings report. In July, late July, around the 23rd through the 28th, you're going to get earnings from the FANG companies again, and they're going to have a tremendous influence on what the stock market does. And I think there's going to be some disappointments. Let me share that with you by going and just sharing how you can look at it by using another one of my tools, and that's Seeking Alpha. Let's take a look at it. This is my Seeking Alpha page, and I'm on, as you can see, Google. I want to start with Google because Google, I think, has its fingers in more things than most anybody else. In particular, I have a reading on it because I'm involved with them in YouTube. They own YouTube. What I want to do is start by going down, and I want to look at their past earnings. We're looking at quarterly here, and you can see that they had a growth from 2021 through the end of 2021, first, second, and third and fourth quarter. And that was when, for the most part, we were still stuck at home. We were doing a lot of YouTubing. We were doing a lot of search on YouTube or on Google. And so their earnings were good. Now you see second quarter, you see they came down. In fact, they were at 65 billion here. They were at 68 here. The interim quarter was 75. They're now projecting 70 and up from 68 to 70. I don't think they'll hit that. I really don't. And again, I judge that from the traffic that I see on YouTube. People are going to work. They aren't sitting at home watching their YouTube channels as much as they were. Thus, Google is not selling as much advertising. And I have to believe that's the same in search as well. So that's one element of their earning report. The other element is going to be their quarterly earnings per share. And as you can see, they have beat projections all of 2021, and the black line being their estimated, and the blue line being their actual. Until then, in 2022 first quarter, they did not beat their estimates. In fact, they fell short. Now, what you're going to see, they're even estimating higher for a second quarter, and I don't think they're going to make it. I think you're going to see another blue line down here, probably below this blue line. That's 24.6. They're saying 24.7. I think it'll be down, I don't know, somewhere around 23. That being said, I have to then feel that after this report comes out in July, that the end of July, you're going to see an additional drop in the value of Google stock. And I think all the FANG stocks and most of the social media stocks will travel in that same direction, because I think Google is a good representation of the advertising community. Now I want to take you to the consumer products industry, and I don't think there's anybody better to get that reading from than Amazon. And this is my Amazon chart on Seeking Alpha, full of information. Tells me right there they're down 39.1%. Year to year, down 37.66 for year to date. But I want to go down to their earnings and get a feel. And as you can see here, this is annual. I want to look at quarterly, because that's what's going to measure what happens. And you can see as the pandemic progressed, and here we're in the first quarter of 2021, it was starting to slow down, but they had a fabulous quarter. And of course, they had a wonderful fourth quarter because they sell a lot for Christmas. This is Amazon's season. Then you see they dropped substantially, as you would expect them to, because that was Christmas. This is not in the first quarter. But they're projecting that second quarter will be stronger than first quarter. I'm not so sure about that, and I'll tell you why. Then let's go to our quarterly earnings per share. And here you can see they've consistently last year outperformed, came short in third quarter of 2021, then blew the doors out in fourth quarter of 2021. Again, Christmas season. But my goodness, look at the earnings they cashed in there. Then first quarter, they kind of missed the ball. And I don't know, and I don't know well enough to know if this overwhelming high performance somehow created this lower. But nonetheless, you can see their projected revenues per share are down for 2022. And this is why you've seen the price go down in Amazon. Now, do I think they'll... Here they had a projected 42 cents a share. Here it's all the way down to 17, and that's because they lost 38. My feeling on this, and I'll be very honest with my measurement, we have two distribution centers here in Birmingham. They each employ about 3,800 people. One of them is within probably 4 miles of my house, and I drive by it quite often when I go certain places, and I see there are not as many cars. In fact, there aren't many cars in their parking lot during normal working hours. Now, I can see the drivers moving up and picking up their deliveries, and maybe that night shift is taking care of everything that the drivers need, and they don't need a day shift. I don't know. But there used to be, back here in fourth quarter, that place was packed. It was packed with people. So I'm anticipating that we're going to have a disappointing second quarter earnings season. That again is going to come at the end of July, and that's what I'm partially making my next 6 month projection on the stock market. It's based on what I see here. Okay, what I'd suggest you to do is do what I just did and go to Seeking Alpha and look at the earnings reports of those stocks that you're heavily invested in and get an idea of what's the probability of with the people coming back to work, with people back on the highways, what's the probability of these stocks benefiting from the change in the patterns of how people were living from 2020 and 2021 to now 2022 and 2023. How is it going to change? As I said, I think retail is going to take a hit. And I think that you're going to see, of course, some increase in prices and profits from energy. But I don't see energy as a long-term investment. I see the world wanting to basically save themselves from global warming, and carbon energies are going to go away. But on the short term, that could be a good trade. But again, I believe their earnings are going to be up. I don't follow energy. If you do, take that into consideration. The next thing I think you need to consider is that we are going to have a midterm election. And that midterm election, as I read it, is going to throw a favor to the Republicans, that they'll probably change their stature in both the House and the Senate. And then you have to decide what, in fact, are their motives and what do they want to do for the next 2 years, because their number one objective is going to be get rid of a Democratic president, whoever that might be. I wouldn't be at all surprised that shortly after the midterm election, probably around the first of the year, that Joe doesn't announce that he won't be running again. That will give Ms. Harris the opportunity to step up as the number one candidate, and some other Democrats that we all know who want to be the number one candidate, and then create their stature relative to who they believe the Republicans are going to be put up. I'm mentioning this because this is going to have an effect on the stock market over the next 6 months. So with that being said, I guess I'm saying I see a continued downturn. I see lower levels. I showed you in the chart the Fibonacci levels that the QQQs could potentially come to. But I think what I would say is I don't know that. I feel confident that we are not at the low. I showed you the flush point. I don't think we're there yet. I think that the market will take another good-sized dive. But even, I don't know that. But what I want to be doing is dollar cost averaging. I believe very strongly that Amazon, Google, Microsoft, Apple, and NVIDIA are at a lower price than they will be a year from now. So I want to, every month, put some money into those stocks. Now, I also believe that genome sequencing, genome editing, and artificial intelligence and the supply chain will create some real values in some smaller stocks, but I'm already in those, and I'm comfortable with my positions. If you've watched my channel, you know that I liquidated my Facebook stock, so I have some cash sitting on the sidelines, and that's what I'm going to dollar cost average into Amazon, Google, Microsoft, Apple, and NVIDIA, because I believe they have the knowledge, they have the skill, and they have the money to participate in the change that is going to come through our markets. Now, with that being said, I think you have a pretty good idea that I predict that the market will go down further. I predict it will react very heavily to earnings season end of July, and then it will take guidance from the midterm elections. That will be around the 1st of November. I then believe if it does stay down, by March of 2023, we will have a turnaround. Okay? That's what I believe will happen. Okay. What I also think is important that I mention is what to stay away from. Stay away from China. China has problems that they are hiding. They're pushing under the rug. If you'll remember the name Evergrande, this was their largest building contractor who basically went belly up, and then some of their other building contractors went belly up, and their citizenry lost a lot of money in their real estate investments. That's what happened over there. Those houses were, those apartments, those not apartments, but condos, were pre-sold to Chinese people in anticipation of the people from the hinterlands moving in to take the jobs that China foresaw that they would continue to grow their economy through selling products to people in the United States and the developed world. Well, we've all learned that's not a good plan because of our dependency and in the supply chain and the fragileness of the relationships with certain people in the world, that we have to bring that manufacturing back to the Americas. And then China is basically losing its largest customer. In addition to that, they aren't making babies. They haven't made babies since 1975 through 2015, when they had the one-child policy. So their demographic pyramid is turned upside down. So, and then on top of that, they rely on food and fuel, energy from other places. They have a lot of vulnerabilities, and their biggest client, their biggest purchaser, has decided we're bringing manufacturing back to the United States, and we're going to de-globalize. That being said, stay away from China. Then I would also say, on a little bit more hesitant scale, stay away from international stocks. Germany is between a rock and a hard place right now. They need Russia's energy. A lot of countries in Europe need Russia's energy. And that whole situation could blow up. That's a risk you don't need to take. There's plenty of good investments here in the United States. So again, dollar cost average into those stocks that you believe are going to take you into the future. And I know you're saying Tesla, but please remember, Tesla has 1/3 of its projected sales living in China right now. And you don't need to take that risk. I think I could make a good argument that Apple is going to end up being one of the premier electric vehicles here in the United States, and they will probably replace Tesla on the top of that. And I don't want to own car companies. Please study car companies. They don't make money. They usually end up unionizing. Hell, if they can unionize Starbucks and they can unionize Amazon, it isn't going to be long that they unionize Tesla and anybody else who's making automobiles. And that basically history says, and I know we don't learn from history, but let's do, and realize that car companies don't make money, but the companies that support the car companies will make money, and I did a video about that. Okay, that's what I have to say on this subject. I've introduced you or used two of my tools. You're going to see in the description a link where I've written a a bit of a white paper on the value of tools, and then I've shown you the tools that I've used, and I've negotiated some discounts on those tools, such as Seeking Alpha, that you can get a discount and you can learn to use the tools at your leisure and become a better investor. And then the final tool is our tribe. And that is to say, you don't want to be doing this by yourself. Even Mike Tyson, who was one hell of a heavyweight champion, he had a team. He had a trainer. He had people that kept him focused, that got his head back into shape when he got punched in the face, and reigned as champion for quite some time, as did Muhammad Ali. I can't pass on Muhammad Ali. Phenomenal athlete. Okay, that's my take. That's my advice. No, education. And I'll talk to you again tomorrow about similar subjects. But that's my prediction for the next 6 months in the American stock market.